Welcome back. Montgomery Investment is a fund manager who looks after good value, or looks for good value companies that the market has not valued properly. David Buckland is the CEO of the business. So let's just see what companies fall into this undervalued category right now. David, thanks for joining us.
My pleasure, Peter.
All right, mate, just the overall feeling for the market. Has this market got a potential to go up over the next 6 months, or are you still a bit nervous about it?
No, we're very cautious, Peter. Look, the first thing is we know that household indebtedness is at record highs. The second thing we know is that wage growth is running at multi-decade lows. The third thing, and if you don't mind bringing it up, is this electricity situation. If you don't mind bringing that up on the chart now. But what we've seen is with Hazelwood being decommissioned in March, the price of wholesale electricity, baseload electricity, and Hazelwood made up about a quarter of the Victorian baseload power requirement. But we've seen the price in New South Wales, Victoria and Queensland more or less double and a half, from $40 to $60 per megawatt hour to about $90 to $120 per megawatt hour. Now that's going to filter through, and we know this, into the price of our electricity and our gas to the tune of sort of 20 to 30 percentage points, effectively starting now on the 1st of July. So you've got a highly indebted householder who's going to become even more indebted, and from these very, very high electricity and gas prices, and then wrap that up with the banks, from a regulatory point of view, pushing interest rates up for particularly interest-only loans. So we sort of see a scenario, Peter, where the domestic economy, we think, is going to struggle. And the problem with small caps is that in general terms they're so much more focused on the domestic economy rather than the very large stocks. So within the small caps, I think you've got to really try and look for those businesses that are sort of extremely well positioned, B, very, very resilient, and C, have pricing power. And I have to say there aren't a huge number of them.
Yeah, and I guess what you're saying, David, is that if a company is not dependent on the hamstrung consumer, and you've painted the picture that consumers are going to be more hamstrung by potentially slightly higher interest rates and very big rises in power bills, you're not seeing anything positive on that front. So if you get a company that may well be a mining services company linked to an iron ore company that's pulling a lot out of the ground and is starting to maybe invest some capital after a while, that kind of company might do well, but not the traditional consumer-exposed company.
No, and then if we just put the second chart up, Peter, if we don't mind.
Yeah.
So what we're seeing here in this second chart, if your colleagues can put it up, is that we look at 12-month residential construction approvals. And what we saw is that approvals have been running enormously over recent years, particularly when the mining boom turned down. And they've been running at sort of 15, 20, 25% growth rates. And suddenly, the approvals, which lead the actual value of construction, are now running negative. Now, this leaves the construction by sort of 6 to 9 months. So it's my view that by around Christmas, the value of construction in the residential space will actually be running negative. And so a lot of businesses that have enjoyed this wonderful time post the mining boom of these very, very high rates will start to see negative rolling 12-month year-on-year numbers.
Okay, so David, you sufficiently scared the pants off and I hope you're wrong, and I'm going to try my best to try and prove you wrong over the next few weeks. But if you are right, what kind of companies are exciting you? Are there any companies that are exciting you?
Yeah, there are in the small cap space, Peter. So we own a business called BWX, and that makes Sukin, which is a
Sukin.
Yes, it's a natural product.
Name, isn't it?
Yeah, it's actually a natural product. But what Sukin have done, or what BWX have done, is that they've moved this natural sort of face care product into the Boots operation in the United Kingdom, which is obviously a large sort of chemist-type organisation. But they've also just made a small acquisition in the States, a business called Mineral Fusion. They've spent about $50 million. And Mineral Fusion is also in the natural cosmetic industry, and they sell through about 3,000 outlets in the US. So here's a company that's got this sort of Australian brand called Sukin, and it's moving from just facial products into the whole natural cosmetic space, and it's moving from Australia into the United Kingdom and into the US. So that's called BWX, and I think it sort of looks quite exciting. A second stock that we quite like, Peter, is QMS, which is a digital outdoor advertising organisation. And with the fragmentation of the media, what we're seeing is that advertisers are really looking for high return on invested capital, and this digitisation of outdoor, firstly, can sort of has a much greater measuring ability, but secondly, I think is much higher return on invested capital because it can move the ads around much more effectively than the old sort of.
So tell us about the company again.
It's called QMS Media. It's capitalised at about $370 million.
Okay. So does it actually service the likes of APN and all those companies, or are they in competition with them?
Yeah, so things like APN Outdoor would be a competitor.
A competitor,
yeah,
okay.
Yeah.
So QMS is actually quite, because when you drive around the territory, you see APN, you see but I haven't seen any QMS.
Yeah, it's just, look, it's a branding issue, but as I say, it's one of the sort of three majors in this country.
Okay. Any other companies that are grabbing your attention?
Peter,
right
we still quite like the IVF space, simply because we think it's got sort of very, very resilient attributes. It's got sort of certain pricing power. So there's two stocks, there's Virtus and Monash IVF, and they're both capitalised at around about $400 million. But again, quite like that sort of resilient, those resilient attributes, and specifically the sort of the pricing power, again in an environment which we think is going to be quite challenged, particularly as the financial 2018 year progresses.
Yeah, well, the thing I've noticed is a lot of young couples I know have actually gone on the programs, and a lot of them have had more success nowadays than they did in the old days, where I think there was quite a lot of disappointment. But both those companies have had a few challenges in recent times in terms of the share market loving them or not. Yeah,
that's right. They've had their challenges, but I think on a medium to longer term view, they do represent pretty interesting value.
Do they have potential rivals, or do they pretty well cut up the market between them?
There's a group called Primary Healthcare that's got into the space in a sort of, I call it a sort of an Aldi version of IVF, but I think couples who have maybe delayed having babies or having trouble having babies, I don't think the Aldi model of IVF is probably as successful as sort of a very hands-on model.
So it's a very interesting comparison that you use Aldi. Cut-price babies, you're suggesting, aren't all that popular.
Well, I don't think so.
All right, David. Thanks for joining us on the program. David Buckland, CEO at Montgomery Investment Management.